But we've also got Sunil Subramaniam joining in the show right now. Sunil, hi, afternoon. A momentous day for you. May not be for the markets, but 25 years of the fund. For those who are looking at this current market fall, and especially in context of the post-budget rally, Sunil, that we saw, what is it that you would like to tell mutual fund investors who are more long-haul investors? Next 5 years, 10 years, today's price aberration or the last 1 week, does it even matter?
Over the years in the channel, right? We've been always bullish, always positive, because we believe that the underlying economic footprint of India is clearly on an upward trend, and the equity markets will respect that. Any corrections that happen are a time to buy. That's what we've learned in our 25 years. And as a sample, let me tell you, our mid-cap fund we launched in July 2002. It's delivered 23% per annum to the investor. So effectively, if you take the rule of 72, it's doubled investors' money every 3 years, roughly 3 to 3.5 years. So what more do you want, right? So I think ultimately for us, these budget rally or the inflation correction today are just events in the market. Ultimately, the economy drives the earnings growth. The market has to respect the earnings growth. And that's what investors will gain. So I think from a 5-10 year perspective, if you have that kind of a thing, systematic purchasing is, I think, the best way where you don't get these heart attacks, right? In terms of the correction today, you feel very bad. If you had put the money yesterday, you'd say, oh, I should have waited for a day. So these are all emotional reactions, right? So I think if you have a systematic allocation pattern, whether you do it through SIPs, keep the money in liquid route through STPs, or just have a trend line of the market and say when it corrects 5%, I'll put in more money. So systematic allocation is the best route to do. Second, diversification. See, very often people look at diversification saying it reduces the risk but not the reward so much. But there's another aspect to diversification, which is that diversification helps you pick the pocket of best returns at all times. It's because you take 1.5 years ago, nobody would have invested in pharma. But the COVID crisis suddenly gave a pharma a big push up, right? So if you diversify across multiple asset classes, right, then you will be there when the market surprises you. So the doubling of the market from March of last year to now, nobody predicted it. So the key is that if you stay diversified across it, take a systematic approach, then for us, that's where investors, our investors, more than 3.5 million of them who have invested through us, and lots of them have stayed the journey, stayed the course, and they have enjoyed the benefits of the market. So I would say that to our investors, message is keep continue investing. To other investors, look at the track record of the long-term company, and we made profits every single year in these 25 years. So it is possible that a company which is anchored to the economy, right, essentially like us, derivative of the economy like financial services is always going to deliver you an X alpha return over the economic growth of the country. I think that's the ultimate message. Stay hungry, stay bullish, stay invested.
Okay, Sunil, lots more to chat about with you. Just stay with us. We're going to take a very quick break, but come right back. We'll continue our discussion with Sunil Subramaniam.
Welcome back. The absolute rout continues to play out across the equity markets. That startling surge in the US yields has really sparked this sort of a sell-off across the board, not just our markets, but global equities all year round. And Nikunj, we were talking with Kunal earlier, and perhaps he was talking about the extent of... Okay, let me take that question then to you, Sunil. Just purely going by what we're seeing today, this rates perched at that 1 year peak, and that's been stoked by a lot of inflation concerns. And what we were discussing with Kunal was that perhaps the extent of the fall that we see purely in today's trading session, or that bounce back, is sort of going to determine the extent of what could play out over the next few trading days, whether or not this is sort of just a flash in the pan move. Given that you said that it's this decline is a good buying opportunity, there is no concern, fear or worry of this escalating further?
I think it's a knee-jerk panic reaction, number one. Second is, if you look at the inflation story, right? So why is inflation spooked the market? Is because there's a fear that the liquidity, which FII money has come in, could reverse to some extent and go back there, because interest rates have gone higher. So somebody might invest in US T-bills today. Somebody's borrowing cost would have gone up. But look at it, that what is inflation telling you? The inflation, projected inflation going up means that demand is going to exceed supply in the United States. When will demand exceed supply? When consumption is booming, when the US GDP is growing. Now that's good economic news. So if you see a US which thrives as an economy, immediately means that the rest of the world which supplies to the US, China is a major beneficiary, but India, as a China plus one strategy, is in a pole position. So, see, how long can you expect only a liquidity to sustain a rally? We need economic growth, and a significant part of the economic growth comes from our export story and taking advantage of our low-cost labor, our land availability, our ease of doing business. So that long-term story will get reinforced, and that's why I call it a knee-jerk. Yes, there will be short-term liquidity outflows, but long-term money will come chasing, because ultimately a US economic story is a good story for Indian economy. So I think let's not forget that the basics of the market is about earnings related to GDP, and a decent amount of inflation is necessary to keep the economic wheels turning. So I, for one, am not a bear when it comes to looking at inflation, because for me, liquidity will come and liquidity will go. But it's the sustainable economic growth of our country for which we need an advanced world on a good growth path. So look at it on the bright side of this story, is what I would say.
Okay, fair enough. The point has been taken. But let's nail it down then to individual sectors. And given that the banks are really facing the brunt at the current juncture, what's your outlook in terms of the overall credit growth, the asset quality, where you see some of these PSU banks that have incidentally had a pretty phenomenal series gone by headed?
I think that the reason the inflation spooking means bond yields rising means that banks' holdings of non-lending assets, either in G-Secs or in commercial papers, that mark-to-market tends to bring it down. Hence, in the short term, their EPS from the non-core business, that is a non-lending business of the banks, may come down. That's the reason you see private sector banks correcting, because they generally are very careful lenders and keep a lot of money in treasuries and all of that as a smart methodology. So there could be a short-term correction in the earnings. But in the longer run, right, if you look at the fact that a rising inflation means rising growth, banks are actually poised to benefit because they are the ones going to finance that growth. And ultimately, any rise in interest cost will be passed on to the borrowers in a scenario where demand exceeds supply. When demand exceeds supply, the price is set by the supplier. So money is a commodity like any others. When demand for money exceeds supply is when interest rates go up, but the price is set by the supplier of money, which is the banks. So again, coming back to the same story, is that the core business of banks will actually stand to benefit from this rising inflation, from rising GDP story. Short term, there will be corrections because of the mark-to-market losses of their portfolio, but that's not the core business of the bank. You know, that's just a surplus money being managed in a treasury. So I would say the fundamental thing about banks' core net interest margins, I don't think has been affected by this. So again, a reaction is a short-term reaction to liquidity. And finally, the reason that 35% of our large cap index is the banking sector stocks. So when FIIs pull out money, naturally they tend to pull out from where they have a lot of exposure, and there has been a recent run-up, so profit booking also comes into play. So overall, I don't see that as a sustainable thing. I think longer term, PSU banks, the story is different. It was a value catch-up playing, right? Because related to public sector, private sector banks, there was a huge gap. All the news around the budget, the capitalization, the bad bank creation gave it a positive feel. Mergers, strategic divestment, all of that gave it a good feel. So that correction in the valuation, which was huge on a price to book between private sector and public sector, has narrowed. But public sector banks ultimately will thrive only when the Indian economy thrives. So I think keep a close look on the GDP revival and the economic revival. That's when public sector banks will really reap the benefits.
Sunil, we'll let you go on that note. Thanks much for taking time out and joining in. Let's take a quick break, a quick update. 14,664 on the Nifty, the Sensex of 1,500 points.